Hello and welcome. I'm Roger Roundy, the CEO of Strategic Associates. Got Caden Gunnell here as well. Our objective today is to give you a high-level overview, actually a deeper dive on some of the structures that we have. This is part of a series of videos that we're going to be publishing in order to help our clients understand some of the programs that we offer. For those who are not familiar with Strategic Associates, we are an advanced tax mitigation consulting firm in which we help our clients find, utilize, and implement some of the structures that we help promote through either investments or participation in these programs. Our objective is to help you reduce your taxable income and obviously keep more money in your pocket through advanced tax mitigation. As a disclaimer, this is not legal or tax advice. This is just education on your opportunity to participate. This initial program we're going to call BoxHouse. It's our BoxHouse accelerated depreciation / bonus depreciation program, in which we're going to help our clients purchase a box house. Now, what a box house is a steel framed constructed home that's a miniature home. There's three sizes: a mini, a bungalow, and a duplex. These homes are treated for tax purposes like private property. So, but it allows us to take the bonus depreciation on the purchase of this home. Just so you understand how these box homes work, they're manufactured homes in which a participant raises their hand, says they'd love to buy a home. Okay, how much is it? Well, there's three different sizes. It's a 1 to 5 offset, meaning you're putting in a down payment of $130,000 for a $650,000 home. That home upon purchase is yours and becomes part of a pool of other homes that are stored to be used for various purposes. It can be for workforce housing, it can be for disaster relief. And how it works is we're buying these homes and then we're going to store the homes. The reason why we call them box houses is because they're able to be boxed into a shipping container. The patent that allows us to do that is what creates such an awesome opportunities to not only mitigate our taxes through this investment in the home, but also hopefully benefit from rental income once your home is deployed. So the homes are stored, and basically how it works is we utilize a company called ReadyPod. ReadyPod manages your home along with all the other homes in that pool of homes. And FEMA calls up and says, hey, we've had a hurricane in Jamaica. We need 200 homes. Please ship them here. Boom. But ReadyPod sends the homes, and then FEMA or Jamaica or whoever is paying the rent on these homes will pay ReadyPod, and then in turn, you'll receive rental income from that home. Now, that's the high level overview on the utilization of the homes. But I want Caden to kind of go through exactly how the tax benefits work, some of the nuanced differences on what makes this work so well, as opposed to perhaps other real estate type investments or tax mitigation strategies that you have. So, Caden, can you just kind of walk through the three different types of homes, the sizes of the homes, the numbers, and then we will go through and talk about things that make this work.
You bet. So I'm going to share my screen here just so everybody has some visuals, and then kind of just further clarify the stuff that Roger's already mentioned. There's a distributor for the box home called Highland Steel, and they're the ones that you're ultimately going to be partnering with, because we're going to do this inside of a LLC structure. And so I'll walk through all that as well after we kind of help you understand what you're buying more. But like Roger said, these homes have been used for other things in prior years. I think there's over $15 million worth of these homes in West Texas right now on an oil and gas rig, where the owners of those homes were just like you, right? They got to take the bonus depreciation. They own that home inside of a LLC structure, but that oil and gas company's making lease payments for their employees to live in those homes. And so much like I like the comparison of short-term rentals in real estate, kind of like an Airbnb. You get to buy an asset, but you get to take the bonus depreciation now. And then you do have the opportunity for an income stream from that asset. Why we qualify for the bonus depreciation, and our legal opinions go through all this, but it's good to know is, you are the original intended user of the home, right? That's a big important aspect. And like Roger said earlier, it is personal property, right? Because these are trailer-like homes. They're mobile. We could obtain VIN numbers here in the state of Utah, where a lot of them are manufactured. But personal property, when it comes to the deductibility, of personal property. What bonus depreciation says around that in the code is the full cost is deductible. Okay, so we don't have to go perform like a cost segregation study like in real estate. It's really just the fair market value of this asset is what's deductible as long as you're the original intended user. Okay. Um, what the homes are going to go towards, like Roger said, this year, this is what we really are planning on most of them going to is the natural disaster relief efforts. Because agencies like FEMA do have a big problem, their current solutions, for lack of a better term, they just suck. They're not very good. There's a lot of statistics. You're welcome to pause the video here and look through some of these. One that's not on here that I'm aware of, talking with Highland, is that during the Maui fires, you know, the agencies that were in charge of costing the cost for these displaced families out of their homes was costing around an average of like $1,200 a night, right? And so the current solutions are just not very good. The other tiny homes on the market aren't as robust as these, where these are made out of 100% steel. Um, and again, the transportability is not as good, like Rogers mentioned. You know, these homes fit into shipping containers. They pack down into a shipping container. I'm aware that 2 employees can put up 4 of these a day. So you go put 20 employees, and we could have hundreds of homes set up in a month when natural disaster strikes, right? Which is a really, really cool thing that we always like to say this, Roger and I. It's, hey, I'm not trying to not pay taxes. How am I partnering with the government here, right? And that's why this incentive exists, is because these are assets that benefit society. They're going to lose value over time. So Congress is simply saying, we'll let you take a deduction for that loss in value over time, and we'll let you bonus it to year one. That was part of that one big beautiful bill, right? 100% bonus depreciation. We can take that full deduction in year one of owning this asset, because again, these are assets that benefit society, right? So that's the incentives here. The incentives are aligned, but you're going to have the opportunity to purchase one of these three sizes, and the total fair market value of this asset is what is going to be deductible on your personal tax return because of the structure that we buy this inside of. And so before I go over that structure, just so everybody knows, there, like Roger mentioned, the three sizes. There's the mini box, which is a 70K down payment. So 20% down. That's where his 1-to-5 leverage comes from. We're just putting 20% down on the asset and financing it. Well, 70K, that would create a $350,000 fair market value based on the appraisal for this home. The bungalow, it's a single family unit. I'm aware you can fit up to 10 people inside of this. 100K down, 500K deduction. Okay, so just 20% down again. And then the duplex, which has a lot of demand right now. 130K down and 650K would be the total bonus depreciation deduction amount. Okay.
So Kate, how do we determine that value of 350, 500, and 650?
It's going to be from actual appraisals, right? And we've got those, so those can be shared, but it's not just what the materials themselves are worth. There's other factors that go into that appraisal, including, you know, future cash flows, and we have historical
Income, and so
yeah,
certain things like that. Gotcha.
yeah,
Okay.
absolutely. Yep. So that's the options you'd be able to purchase. Raj, do you want to now maybe walk through a calculator to show people how that would affect their tax savings?
Absolutely. Let me pull up my.
I'm going to pass it back to you here. And if you
So,
need,
um, for those who have worked with us in the past, you've seen how we like to illustrate. And again, these are just illustrations. A little disclaimer there that whenever we illustrate numbers, they're safe guesses. Okay, so
financial,
obviously, um, every every individual's tax situation is going to be a little bit different. But what we're going to show here is, let's pretend that we have a $200,000 business income. You're paying yourself a W-2, okay, or you're high income earner, and you may have a little bit of interest income and so forth. So what I'm showing here is essentially someone who has an AGI of $1,200,000. Well, the tax liability on that would be $422,000 between 360 of state and 540 or federal and 554,000 of state. So $422,000 total taxes for the year. Instead, what we're saying is, hey, let's participate in box house strategy. Let's buy a bungalow. Okay. Well, a bungalow, the total cost, sorry, not a bungalow, duplex. So again, you'll see we can either do a mini box bungalows or duplexes. You can buy multiple of these. But if we just do one duplex, the total cost is $135,000. Okay. that $135,000 is going to create a $655,000 reduction of taxable income through bonus depreciation, plus the $5,000 expense fee is going to be deductible as well. Now, that $655,000 deduction is going to reduce your AGI from $1.2 million down to $545,000. So now we're left with $545,000 of taxable income. Your tax liability goes from 368 down to 129 at the federal level, and from 54,000 down to 24,000 of state. So now our total tax goes to $154,000, meaning we've reduced our tax liability from 422 down to 268. You'll find always in these structures, when we talk about them, there's always going to be a red line. That red line is your total capital requirement to the structure. On this, and then we always have our green box. Our green box shows us the benefit. Our gross benefit of reduction of taxation is $268,000 less money we're spending on taxes. We are taking $135,000 and purchasing a box home. That's going to be our capital outlay. So net ahead, we're $133,000 net cash flow increase or net tax savings. That's a close to 100% return on investment. We're spending 135,000 to save 268, so we're net ahead $133,000 while purchasing this home. Okay. So that's the math. Okay. And again, what we do, and for those who are not familiar with strategic associates, we're going to do this depending, everything, just to kind of take a quick break on understanding our process. As a group of individuals who are desiring to help you implement these types of structures to reduce your taxable income, our process is pretty simple. What we need to know is how much income you have, what type of income is it, how is it being taxed. When you bring us that information, we're going to identify the strategies that make the most sense. For this scenario, a box house, paying $135,000 to reduce your tax liability by 268, that's 100% return on investment. So that's the duplex. Again, we can run any of these scenarios just based on the type of income. This one's going to be the best. But now, after we know the numbers, Cade, why don't you walk through exactly what it is we're doing and how are we turning $135,000 into a $655,000 deduction?
You bet. And one thing I just want to add here is keep in mind, depending on what state you're in, some states allow you to take bonus depreciation the same way you take it at the federal level. Some states make you take it over time, right? Either way, you're going to get your benefit. These are 6-year depreciation life assets under what's called the MAKERS. It's an acronym that the IRS gave us for the Modified Accelerated Cost Recovery System. So if you don't get it bonus to year one in the state, just know you're still going to get it over 6 years at the state level. It'll carry forward that deduction, so you will still get that benefit at the state level. Okay. How we make this all happen, though, it's easy if I give us another little visual. Let me share my screen, because there's an aspect here that some of you might be asking yourselves if you are familiar with how some of this stuff works. The first question is, hey, how am I considered a material participant to be able to take this depreciation? And we'll go over what that means. But it's very important that we purchase this in a way that allows you, we have this asset that is considered qualified property for bonus depreciation, but for you to take a bonus depreciation deduction against what's called your active income, you have to be a material participant in the trade or business where that deduction came from. So we have active and we have passive income. Anytime I want to offset my active income, which would be your income that flows through to you from your business or your W-2 income, right? If I want to reduce that, I have to be having an active involvement in this other business that I own. When that deduction flows through to my personal return, I've got to be considered an active material participant in this business for that deduction to reduce income that I have elsewhere that's also active. Hope I'm making sense there. And so that's why we purchase this inside of the structure that we do. So we're going to buy this box house inside of a series LLC. If you're not familiar with what a series LLC is, just think of it as a way in states like Delaware or Wyoming. They've got really good benefits to some of their LLC structures, but we can ultimately have a master or a parent LLC who can form a related entity, a cell in this series structure, so that you down here as the owner of the cell, you don't have to invest alongside a bunch of other people. It's just you and the master are in business together. And we call them the parent LLC here, okay? But I'm going to start with you as the participant here. And I'm going to follow the green arrows, okay? You are going to fund what we create for you, which is a grantor trust, okay? And the owner of this trust is you as the beneficiary and the settler. Settler is a fancy word for the grantor. And the trust is going to be the 99% owner of the series LLC. And the 1% owner of the series is going to be the parent, which is owned by Highland Steel, that distributor that I mentioned earlier. Okay. So we've got our ownership established. Well, the series is going to be owning and buying a box house. The manufacturer is literally called BoxHouse. They're out of St. George, Utah. Roger and I have spent a lot of time with these guys down in St. George. Great people. But the series is ultimately buying a box house with a 20% down payment and then financing the rest. So that's how we get that 1-to-5 leverage on our deduction amount, is we're just putting 20% down of cash, but again, the deduction amount is 5 times more than that, okay? What that allows for, as the grantor of this trust, which majorly owns the series, all of the benefits when it comes to the tax related aspects, the bonus depreciation, are going to flow to you. But the reason that you're able to take that deduction is two things. First and foremost, how the material participation of a trust is established under tax law and the relevant court cases is the material participation is determined by the involvement and the control of the trustee. Well, the trustee of your trust is also this parent LLC, who is Highland Steel. Okay. In some other structures, maybe you've heard of this 100 hours rule, like with short-term rentals. I got to spend 100 hours in my business. Or if I'm a real estate professional, I got to spend 650 hours in that business to take my active losses against my active income. Maybe you've heard of those things. Well, here, we're not relying on one of those rules that the IRS gives us for how we can substantiate material participation. We're relying on another rule they give us, which again says, whoever has fiduciary decision-making inside of your trust, as long as they have substantial, continual, or regular control, the trust is therefore considered a material participant. Well, the fiduciary decision-making needs to be made by the trustee, and that is the case here. So the trust is considered a material participant because Highland Steel, this is all they're doing, thousands of hours, right? And so as the grantor of this trust, which is materially participating, your material participation status is substantiated. So you can take that full bonus depreciation deduction. Okay. The other reason why we can deduct the full amount is one that maybe your CPA would be asking, or you might know this as well, but it's because your basis in this partnership is equal to the full deduction amount. A lot of people might say, I've only put, let's say I bought a bungalow. I've only put 100,000 in cash. Why can I deduct all 500? Well, that's because basis, we can only deduct up to our basis. That's just a tax law thing. Well, our basis is determined not just by the cash we put in to these partnerships, but our basis is also determined by cash plus income and liabilities. Well, where we're financing this debt, the financed amount shows up as a liability, right? And so because we have a liability of the financed amount, that'd be 400,000, and we put 100,000 of cash, our total basis is 500. And that's the other reason why we can deduct the full amount. Okay. Making sense there, Roger? Anything else you want to clarify?
So in other words, you've got Highland Steel and a bunch of little series LLCs, right? You would own one, I would own one, and we have created a trust that Highland Steel happens to be the trustee of. Because there's a trustee, we can use their material participation as it flows down to our trust so that we can actively participate and receive those benefits all up front.
And if you're like me, just go read our legal opinions because there's going to be 2 different court cases that show that the IRS set the precedence. The material participation is determined for the trust as long as the fiduciary trustee has control, right? And
Good to have the smart guys on your team. I'll just put it that way. So ultimately, that's okay. That makes sense to me. A couple questions I would have then is how this box house is financing my home.
yeah.
Maybe explain to me how that financing works because I don't like debt. So Tell me how the debt works that I've now accumulated by buying this home and only putting 20% debt.
Yeah. So first and foremost, it's a private loan. So this isn't going to be something that shows up on your credit report. The loan is to the LLC, right? For the basis, the guarantor of the debt is the trust, because that's important. Again, you have to have a real liability for to step the basis up so you can deduct all 500,000 there. But it's a 9-year loan. It's a private loan from BoxHouse, who is the manufacturer and also the lender, right, of this unit. And that's why
Okay.
they don't need to do any additional underwriting because the collateral is the house itself, right? It's just a 9-year loan. The terms of the payments are that they are interest only, right? And they're going to be midterm AFR, which I think this month at the time of this recording was like 3.8%, right? And so to kind of tie back to now how we take care of that loan and how we service it, I like to, again, just use the Airbnb comparison. Think of if you were to get a seller finance note or a mortgage on an Airbnb, you'd be servicing that payment with income from the short-term rental income. But any excess on top of your payment is going to be cash flow to you. That's your reason for going into business. And that's our same reason here. Outside of tax benefits, what is our economic benefit? It's that we get to own an asset that net of those debt service payments, which are again just interest only, broken up monthly. Net of those, we expect cash flows and profit, right? And who's responsible for generating that profit is Highland Steel in conjunction with the company Roger mentioned earlier, ReadyPod. Okay, so ReadyPod is going to be the moment you purchase this home, it's going to go into storage with ReadyPod, assuming that's what you've elected to do. Okay. Another reason that's important is because these homes, to get the bonus depreciation for 2025, you have to have them placed in service. Well, when we store them with ReadyPod, it is considered placed in service prior to year end. Okay. And then ReadyPod and Highland, they're going to be go looking for these opportunities. You know, if they need to go back to the workforce housing like they've done in prior years, we're averaging 8 to 900 bucks a month in cash flow on those opportunities. Great option. We're seeing a lot better opportunity with the natural disaster relief efforts. And so, Roger and I are aware of some of the leases that are already in place, leases that are currently being worked on. You know, there's going to be the likelihood is that there is a great income opportunity on top of just those interest only payments. The cool part is the first payment isn't due, and this is via the promissory note agreement. It's not due until January 15th of 2027. So those who are looking to purchase this home this year for 2025 to benefit from the bonus depreciation, absolutely. The goal is you'll be benefiting a lot from any leases that the homes go get put towards inside of the year of 2026, and you won't even have payments starting until 2027.
So I can accumulate some of that cash and
Mhm.
have plenty of capital to pay any future
Absolutely.
payments.
Absolutely.
Okay. Any idea on the average amount of income we should expect on, say, a duplex?
Yeah, I would say the income that we're expecting and speaking with Highland Steel, net of debt payments, we're thinking of north of $2,000 a month. If it's less, what I always like to say is, one, there's some protections Roger and I are going to go over, but two, just from our tax savings here in year one, we've got plenty of reason to stay in this thing and try to see this cash flow start working for us because we just saved on that example Roger showed, net of 100,000 just in tax savings. Anything that we can make on top of servicing our debt is gravy, right?
So not
Um,
only did I save $135,000 in taxes, I get $20,000 of rental income next year. Is that what you're saying?
that's the goal, absolutely.
Cool. Awesome. Okay.
Um, and so I would say the next question really is just kind of what protections do you have and what does it look like on the back end? Is that where you want me to go now, Raj? Would you say?
Well, yeah, I mean, I think the biggest thing for me is, okay, how do I not have to worry about this debt service payment, right?
Mm. Yeah.
What if I enjoyed the tax benefits, and then what protection do I have if, my home doesn't get deployed? And
Yeah.
what if we're not making the debt service payment? What's the recourse on that, and how does it affect me personally?
Yep. How it affects you personally is there's protections built in because we always have that worst case scenario. There's risk in all things. None of this is guaranteed, right? Again, it's very likely. But let's say that we don't have enough cash flows coming in. First, I want to make sure we talk about how the cash flows work. It is the cash flows collected, it goes 80% goes right to the trust, 20% is kept by ReadyPod. Think of that as your property manager, right? And so with that 80% of all cash flows, you should be able to cover on the duplex, that would be like 1,600 bucks a month of interest expense if you broke out that 3.83%, right? And it's monthly payments, they don't start till 2027. But let's just say we get all the way to January of 2027 and the payments didn't start till next year in August because we couldn't find a good lease, right? Well, the cool part is a part of your promissory note agreement is that capitalization of the payments does not constitute default. And for anyone watching that doesn't know what capitalization of loan payments would be, it's just simply deferring them to the back end of the loan.
So
So,
payments that I would have had to pay now, I can just add to the loan on the back end, is what you're saying. Okay.
yep. So that's protection number one is we Highland, their goal, and this is word for word what they've told me, right, is their goal is to never have to ask you for another penny. And so again, if you're putting trust in them to go put these homes to work, they're going to be they've worked with BoxHouse. BoxHouse will be flexible with those payment terms. You have the ability to just capitalize those payments to the back end if needed. Okay. Protection number two would just be the ability because there's only a 1 year hold, right? BoxHouse Highland Steel, they're asking for a 1 year hold. None of that is related to a tax consequence, though. It's more just to substantiate that you went into business with them and you did this for the real benefit of trying to earn some income off this, not just your tax savings, right? And so after a year, at any point, though, if you said, you know what, I really liked this, and you were making some cash flows, this could be 3 years, 5 years from now, because again, it's a 9 year loan. If at any point you want to just walk away, you're able to. The trust is able to simply give up its interest, its ownership in the Series LLC. Well, if you're familiar with the principle of depreciation recapture, what that says in tax law is if I sell an asset that I took bonus depreciation on, I have to recapture that as income because I just took a deduction on the value this asset's going to lose, right? I took it all up front and I'm not even holding on to it. Well, the cool part, if the trust just walks away and just leaves the series, the parent company still owns it. So there was no exchange or sale. So there's no recapture of the depreciation if the trust simply decides to leave. And so what
Because
you
then the Highland Steel would just own 100%, is what you're saying. You
yeah,
just give you just be giving them the how. Okay.
the ownership of the series. Yep. And so that's another protection you have. It's not anticipated. The goal is that you're going to market here with Highland Steel. This is your business opportunity to let them go put these homes to work and to benefit from the cash flows associated. Again, your two protections are if at any point there's not sufficient cash flows for the payments to be covered, they can be capitalized. And also at any point, they will allow you to walk away and they would just retain ownership of the home. There would be no exchange, no sale. So you'd have no depreciation recapture.
Okay. And do we want to bring up what would happen with because am I not liable for the loan? Do I not
You
pick up?
remain, yeah. So you remain the guarantor of the debt, right, until that debt is satisfied. But again, Highland Steel, if you put yourself in their shoes, who have had successful exits with these homes, they're going to be watching for these opportunities throughout the whole 9 year duration, with the hope that you're around to be a part of those exits, right? Um, Roger, you're aware, I'm aware of what they did with a mobile home park in this last year, selling it for a very large multiple, which would cover any depreciation recapture and taxes you'd owe on that, plus a gain. But again, if you did want to just walk away, the trust would remain the guarantor of the debt. That way we don't have any recapture issues, right? The debt would still be serviced by Highland Steel, right? And they're going to just be putting the home to work and then ultimately just satisfying that loan at the 9 year mark. It's their responsibility as the whole owner of the series, though. It's not your responsibility. You just remained the guarantor.
So I don't have a debt forgiveness income that I have to pick up on that if I leave the home.
And the only time you would was if the debt was canceled. And the likelihood of that are very low because BoxHouse wants their money. This
Right.
loan is not transitory, right? They issued this loan to make their money someday. And so if that means Highland Steel needs to simply sell the asset off to make sure that BoxHouse is made whole, there would be no cancellation of debt. And so the
Gotcha.
only time cancellation of debt would be an implication is if debt was canceled. And we do have a protection built in for that. Happy to walk through that if we need to on this call, Raj, or we can
I think it's just as long as everyone understands that hey, if I leave, I don't have to recapture the depreciation, nor would I be responsible for any debt forgiveness income that I would have to pick up on a normal loan. If the loan's forgiveness, no loan forgiveness income that I'd have to pick up. So one of the questions we often get. So
yeah, there would be no cancellation of debt income through another protection that's built in. It's a paragraph in one of our legal opinions. And so we just benefit from another set of grantor trust rules so that you do not have to pay cancellation of debt income if debt was canceled.
okay.
Yep.
Okay.
That's what makes it all work. Um, and we would say to kind of bring it back down to real world application and where we're seeing a lot of it making sense. It's the end of the year. There's a lot of strategies out there that say, go get your 100 hours and you've got less than 2 months to do so, right? Well, we really like this opportunity because instead we can rely on as robust rule within the code around grantor trust rules to help you substantiate material participation instead of having to go use a strategy where they try to make you get your 100 hours and justify that in the next 2 months. So that's where this is making a lot of sense.
So then let's talk about the timing of the purchase. Let's maybe go back to the numbers just to kind of
Yeah.
reiterate what we're talking about here, and timing. Okay. So BoxHouse is only able to manufacture so many homes per year. They're slated between 1,500 to 2,700 houses this year that they're still going to be able to manufacture and place in service this year. So there is a limited availability of homes. That's a key thing. So as far as timing goes, the actual purchase of the home is fairly quick. We'll use our same process of you expressing interest. You send an email to roger@strategicag.net. We'll respond with our intake form, and that form will tell us the information that we need to be able to purchase, create the documents and so forth. That process is a very quick process. Less than 48 hours, we can have you the documents necessary and the invoices necessary to make the down payment on the home. Again, what you're looking at is three different price points: 70,000 to offset 350, 100,000 to offset 500,000 of income, and 130 to offset 650. Now there is a processing fee per home, so your total is very close to a 1 to 5 offset. Uh, the purchases, as long as there's homes available, we can still sell homes. Now, 1,500 may sound like a lot, but it's not a lot. So there is a bit of a fire drill going on right now to make sure that if you'd like to participate, sooner is always better than later, right? Especially the fourth quarter, it's go time. There's a lot of people looking for ways to mitigate their taxes. Beauty of this structure is we can use it to offset pretty much any type of income. So whether it's W-2 income, qualified plan distribution income, K-1 income, 1099 income. We can use it to offset any type of ordinary income. Again, depending on how much it is and where you're being taxed, uh, we'll run the math on the different types of structures, the three different sizes. If you'd like to buy two because you need two homes, great, we'll buy two. Now there are some limitations to the amount you can take each year of an offset, especially if you're W-2 or qualified plan distribution income. It's called the loss limitation rules. That loss limitation rule is $626,000 is the most that you can reduce your W-2 or long-term or your qualified plan distribution income.
Can
So
I
go
add a
ahead.
qualifying point there too? That's if you're married filing jointly, it's called the excess business loss limitation, right? So if you're married filing jointly, you can only deduct up to 626,000 if you're reducing W-2 or retirement income. If you're single filer, it's up to 313,000. Okay, that's the most amount you can deduct from active loss from another business, basically, against W-2 or retirement.
We will talk about each individual relationship and opportunity. Just know that if there is a loss limitation, cap of how much you can reduce, it does change it to a carry forward loss next year. So there's a lot of 2 year planning we can do with W-2 incomes, especially because that income is going to come again next year. So those are all individual. Our main objective of this video is just to give you a high level overview of the BoxHouse strategy, so you understand the benefits. Again, just reach out to us. Roger@strategicag.net is the email to send your inquiry to. We'll respond with the information that you would need. Also with our calendar, if you'd like to get on an individual call, talk to any one of us about how the structure works, how it affects you individually. We appreciate the time. Caden, anything else we want to add to that?
Process related would just be some of you might be getting this, I don't know, first week of December. Roger and I are recording this early November right now. And so if this is all you need to move forward, we have an intake form. If you've been working with a strategy consultant, that's Roger, myself, or any of our other guys, our assistants, we can get you that intake form. All we need you to do to get the process started is just fill out that intake form. It gets the demographics we need. You indicate which homes you want to purchase. We can get those docs out to you and get this all done in time. But other than that, I would just say, everybody, thanks for your time. We appreciate your trust and we look forward to working together with you.